Friday fails to add cheer to the market as the benchmark extends downtrends towards the 25,700 mark and underperformance in the broader indices. IT, PSU banks and oil and gas stocks hold on to gains, but other major sectors see selling pressure. Yet another record SIP inflow for the month of December, with SIPs crossing the 31,000 crore mark for the very first time. Overall funds saw outflows due to advance tax outgo in the month. ETF and gold ETF inflows surged, even as total industry AUM slipped marginally. Elecon Engineering under pressure after a weak Q3 with profit down 33% despite modest revenue growth. EBITDA and margins slipped sharply due to weakness in the gear division, higher employee costs and adverse because we're already lower by 0.8%, and that has only been the trend downwards. Even the record SIP numbers that we saw couldn't cheer the market that much. Although in a market like this, you have Asian Paints that's still showing some healthy gains, 1.6% higher. ONGC, HCL Tech, BEL, Eternal, these are some of the select Nifty gainers. On the flip side, NTPC, big cut coming in despite positive news flow, 2.5% lower. Adani Enterprises, ICICI Bank, Sun Pharma, Tata Motors PV, Bharti Airtel, Shriram Finance, Bajaj Auto, and many more stocks. In fact, on the losing end, all of these are seeing cuts of more than 1.5% to all the way up to 3%. So that is what the market is looking like right now. Remember, when we opened, pre-opened, we were indicated to open under slight pressure. When we opened the initial first few minutes, we did see gains of about 0.2 to 0.3%. And then we've only seen a one-way downward trajectory coming in on the Nifty today. And that is what the chart is also indicating. Because if you take a look at the advanced decline ratio, when we were at open, we were smack in the middle for the advanced decline ratio. The small cap index was absolutely flat, but the mid cap index was holding on to a lot of positivity, good gains on the mid cap index, at least when the market opened. To see where the small cap is right now, look at the cut over there, 1.5% deep dive on that stock, that index. Nifty mid cap is also low by 0.7%. So we've only been heading one way, and that is downwards ever since the market opened. Talking about sectoral gainers and losers in trade today, difficult to spot any gainers other than IT. It seems like Coforge, HCL Tech, Emphasis that are doing well. PSU banks also, some select banks showing some gains. Indian Bank was up about 3 to 4% at one point, has come all the way lower to only 0.8% gain. Maharashtra Bank, Bank of Baroda, Union Bank are some of the banks, PSU banks, doing well. On the flip side, the pressure continues for realty stocks. 2.5% cut on the index today alone. Godrej Properties is low by more than 4.5%. DLF, Lodha, Sobha, Prestige, all of these stocks are seeing cuts of more than 2%, all the way up to 4%. So looking very weak for realty stocks today, followed by FMCG, auto, energy, pharma and bank. While we were talking about the SIP numbers today, that's the other talking point. In trade, you had the AMFI numbers that came out for the month of December. We've seen a net equity outflow coming in to the tune of 65,000 crore rupees on the back of the advanced tax collection that was there in December. So tax payments, obviously they translate into lesser investments in equity. So overall, we've seen a net equity outflow. Total AUM has also seen a very nominal drop, but it's the SIP number that has done well, a record high figure coming in at 31,002 crore rupees to be precise. The first time we've crossed the 31,000 mark. In fact, the first time that we've ever crossed the 30,000 crore mark also for the SIP figure. So yes, that's the take on the AMFI numbers as well. That was one pocket of news that we were watching out for. Other than that, it's been news on IEX, there's been news on Vodafone. We'll be taking you through a roundup of all of that as well. But before that, Ravinder is bringing us the stocks that are buzzing in trade at the moment. Ravinder.
Well, yes, entire defense sector is buzzing, especially Mazagon Dock and Cochin Shipyard, where as per ET, India and Germany on the verge of $8 billion submarine agreement. So back of this, both Mazagon and Cochin Shipyard, both the stock is buzzing. And apart from this, on the back of order win, Power Mac project is also in focus, where company has back battery storage order worth of rupees 3,126 crore, which includes a green shoe option from the West Bengal State Electricity Distribution Company. So back of this order win, this stock is also in focus. Elecon Engineering is under pressure, where the stock is down more than 15% on a intraday basis on the back of the weak Q3 FY26 number, where in the quarter 3, company reported a PAT at rupees 72 crore, which was down by 33% year-on-year basis, and EBITDA margin was also under pressure from 27% to 19.8% year-on-year basis. So back of the weak set of number in the Q3 FY26, stock is down more than 15% on a intraday basis. Bharat Heavy Electronic is also in focus on the back of their order win, where company has secured a major domestic order worth of rupees approximately 5,400 crore from its joint venture Bharat Coal Gasification and Chemical Limited for coal gasification and raw syngas cleaning plant in the Odisha. So back of this, Bharat Heavy Electronic is in focus, and the stock is down around 1.5 to 2%. And Bansal Wire is under pressure, where company's 20% IPO lock-in period ends today. So back of this, this stock is under pressure. Ola Electric is also in focus, where SoftBank funds has sell 2.15% stake in Ola Electric in the last few months. So back of this, Ola Electric is also in depression. And if we talk about some of the stock that is in action on the back of their brokerage note, first is Eternal, where Goldman Sachs has come out with a note on the Eternal, and they have maintained their buy rating with target price rupees 375 with a 33% upside potential. They say that the recent stock correction was driven by the concern on a Q-commerce growth slowdown and a rising competition. And lastly, Petronet LNG is also in focus, where JP Morgan has come out with a note, and they have upgraded the stock to overweight rating, and from the earlier rating of neutral, and high target price rupees 335 as compared to earlier target price rupees 295. So back of this bullish note from the JP Morgan, Petronet LNG is also in focus.
Okay, Ravinder, thanks so much for taking us through that. Just want to address the flashes that we were seeing on the bottom of the screen about a minute ago on Vodafone Idea. That stock has had quite the volatile journey in today's trade, up 10% in pre-open, opened with an uptick of 5%. And as in when we started getting more news about Vodafone Idea, that stock right now is lower by about 2%. So that has not been a very fulfilling journey for the Vodafone Idea stock in today's trade. Started quite high, but has come now. This is on the back of the news flow that sources have said to agencies that Vodafone is going to be considering raising debt to boost growth. They may seek local and global banks financing, and one of the investors, Tillman Global Holdings, is still interested in the investment in Vodafone Idea. So while this is positive, the first bit of the news that they're going to be raising more debt at a time when they're already having so much of a backlog when it comes to their AGR dues. Even on the flip side, where we've heard the schedule today coming out, how much they need to be paying that first tranche of 124 crores, then followed by 100 crores over this period of next 10 years. Reassessment of dues is also going to be taking place by the DOT committee. We've heard all of that. And in the morning, when we spoke to our Centrum analyst as well, he also had to say that it looks only likely that Vodafone is going to have to A, start taking tariff hikes, and B, also raise more money to now be able to pay this AGM loan. So this is exactly on the lines of that. And yes, that's the word coming in from agencies, wherein sources tell them that Vodafone is going to be considering raising debt to boost growth. So that's on Vodafone Idea. In the last 1 month, the stock is up about 5.5%, but back under pressure in today's trade. Let's refocus and zoom out and talk about the overall overall market structure right now. We have Kunal Botra, who's joined us on the show as well. Kunal, hi, good afternoon. Talk to us about how you're reading the market weakness right now, because at this point, would you still call this market an opportunity, or now are you slightly tilting towards the fact that this looks like weakness which could be here to stay?
Good afternoon. So yeah, I think we were looking at 25,950 as a strong support for the index, and 25,750 as the next hurdle on the downside, or the next support on the downside. But we managed to break below both of these critical levels for the index on the spot levels. So now this dents the near-term prospect for the Nifty. Looking at the weakness across the market breadth yesterday and today, we were expecting that the markets would probably head back towards at least a dash towards 25,950, 26,000 mark on the spot levels, where the second round of selling could probably emerge. We made a high of 25,940 thereabouts on the spot levels today once the markets opened on a bit of a softer note. But then I think from there we've collected almost 300 odd points on an intraday basis, approximately on the Nifty. So this definitely indicates that the structure of the market has weakened down. The concern for the markets is the number of stocks which are falling below their respective long-term moving averages, 50s and the 200 moving averages. That number on the Nifty 50 is also rising up. And then, of course, add to the fact that there have been fresh additions of short positions which have happened for the Nifty, especially yesterday, 15.5% jump in the OI. So on the back of this, I would now believe that we are looking at an index into a downward trend. But then at every phase, the market would probably get into a bit of an oversold zone like what we've hit so far. But bounces back or bounces should be taken as an opportunity to create fresh shorts.
Okay, so that's the take on some of the stocks that are under pressure. Kunal, amid a market like this, and we'll get to where you're seeing opportunity, but before that, amid a market like this, there's two stocks that are at their 52-week high, just seeing if they're also at their all-time high. One of them is. So the 52-week high, you have Indus Towers and Eicher Motors, and Eicher is also at its all-time high. Talk to us about how both of them are placed on the charts.
See, I think Indus Tower, of course, the stock has moved up higher because of the news flow which started off for Vodafone Idea. I think that excited the stock price crossing levels of I think 450, 455ish thereabouts for Indus Tower. So the moment the markets got a whiff of the kind of news flow, we saw the stock opening up higher. But then I think post that the prevailing market sentiment was the one which governed the trend for Indus Tower, and the stock is back again into a corrective phase as such, specifically from the intraday highs. Same is the case with Eicher Motors. Both of these stocks, the medium term trend looks positive. But what happens is that when the market goes into such kind of a sudden, sharp U turn or a corrective phase, as such, most of the stocks and sectors which have been holding fort, even these stocks and sectors go into a reversal. So you'll have to be very, very vigilant about which kind of stocks and sectors generally tend to move up higher. Generally, these 5% kind of moves, which happens on a gap up note, they generally are taken as an opportunity to try and reduce long positions so that markets are a little bit participants are a little bit more lighter with respect to the ongoing volatility. One factor which we have to watch out for is the India VIX. We were almost at sub 10, 9.5 odd, I think a couple of weeks back. Now we are cruising at almost 11 odd mark for the India VIX. So that I believe is the other concern which the market participants have to adjust towards.
So factors to watch out for, Kunal, amid a market like this. Is there anywhere that you're seeing an opportunity to buy, or are you going to be initiating some fresh sells? What would your picks be for this afternoon?
Yeah, so there are a few shorting ideas or sell ideas. The first one is a sell on Geo Finance. That's a stock which looks weaker on the charts, trading closer to 289 thereabouts for Geo Finance at current levels. Would look out for a near-term target on the downside closer to 280. Stop loss could be kept at 295. The second is a sell on Jubilant Food. In fact, it's been one of the weaker charts we've been discussing over the last few weeks also, that Jubilant Food has been one of the few stocks which has consistently maintained its downtrend, trading at 525, 520 thereabouts. Would look out for targets in the range of 505 for Jubilant Food, and stop loss to be kept at 532.
Okay, so that's on sell rating, in fact, on Geo Financial as well as Jubilant Foods. So yes, Geo Financial is now also a nifty company. It has been for a while. So watch out for that. Earnings for Geo Financial next week, and Jubilant Food Works, just giving you a little fundamental picture over here. Its Q3 update wasn't all that stellar, so mixed move coming in over there as well. And yes, both of these stocks are under pressure, and that's how Kunal is seeing them on the charts. But shifting focus and onto an ET Now exclusive, ET Now has learned from sources that a new incentive scheme likely to be announced in the budget for coal gasification projects in the country. Prakash Priyadarshi joins in with more details. Prakash.
Well, the government is likely to announce a new incentive scheme for coal gasification projects in the upcoming budget. Sources indicate that the coal ministry has sent a proposal to the finance ministry. In fact, the ministry has been working on this proposal for quite some time. Wherein it has prepared a rupees 50,000 crore incentive plan for coal gasification projects in the country. A very significant development coming in. We first reported this development on November 10 last year, and now sources are indicating that the coal ministry has sent this proposal to the finance ministry as part of its budgetary recommendation. A very significant development coming in. In fact, the industry consultation has already been completed, and sources indicate that the coal ministry has also initiated interministerial consultation on this proposal. Once approved by the government, coal gasification projects would be set up closer to, gas-based thermal power plants with an objective to revive approx 20,000 megawatt capacity of extended gas-based power plants by supplying gas from these coal gasification projects. A very crucial development coming in. You are aware that the coal ministry is already running a rupees 8,500 crore incentive plan to gasify 100 million ton of coal by 2030. Now it is with the new incentive scheme which has been prepared by the coal ministry, government is planning to expedite coal gasification in the country.
Okay, Prakash, thanks for taking us through that. So yes, coal gasification is going to be on the agenda, and we're going to be watching out for how the market shapes up on this front. But on that note, viewers, time to slip into a very short break. We'll be talking about more stocks on the charts as well as on the fundamentals on the other side. Back with closing trades, and you have the Nifty that continues to be under pressure around 25,650. Let's get a better sense on what the fundamentals are indicating in the market right now. We have Mr. Dharmesh Kant, the head of equity research at Cholamandalam Securities, joining us on the show. Dharmesh, hi, good afternoon, and thank you for your time. Throw some light on how you are reading the weakness that we're seeing in the market. If there is any sector that you are now looking at in a new light, if maybe you're seeing a buying opportunity anywhere on the back of this pullback that we've seen over the course of this entire trading week.
Yeah, I think the market is still trying to find its feet for the next leg of the big up move, and it's consolidating in the range of around, say, 700 to 1,000 point on the index level, that is the Nifty 50. Having said that, if you look at the earnings, I think the business updates were really good for all the financial space, be it BFSI or private or public sector banks. They all came out with a very good set of numbers. How does it translate into the mainline economy has to be seen. To my senses, it's more to do with the MSME and the SME segment of the growth and the retail part where this entire loan growth has come through. So, I mean, public sector banks were, the best performers in the last 6 months of the last calendar year, which is likely to be so going forward in this year as well. So, this kind of a correction which is happening in the market, one can look into those, quality names out there to get into it. And the other space which has not done so well last year, in spite of the euphoria and healthy order book or a heavy order building around it, was the defense space. Only BL is stock had done marginally bit on the relative terms, but if you look at HAL and all, they have not done really well on the stock price movement. So defense is another area where we are, looking very aggressively to buy on declines, and there the names are very clear: HAL, BEL, and Mazagon Dock. These are the three companies which we are looking at it from a structural point of view. So this two spaces are clear bet. Third is the metal space, where I think the traction is likely to continue going forward. Valuations are still not reached their plus one kind of a standard deviation, and there, as you know, for the infra and the other development push, and dollar index being benign, and all the central bankers of the world are cutting on interest rates. So this buoyancy will remain there. And there, the top two picks are Hindalco Industries from the non-ferrous metal space, where copper, aluminum, and the others in the like can be taken advantage of, along with Vedanta. And in the ferrous space, JSW Steel is what we are liking, having regard to the safeguard duty which the government has implemented. So steel has got some, protection out there, and reset cut by NMDC on the iron ore prices also augurs well for them. So net, I mean, these are three broad sectors, one where one can be constructive on declines to be bought into. Others which has performed well, like automobiles and all, I think it's priced to perfection. From here on, it will be a struggle going forward, because if you look at last 4 months number on the two-wheeler side, there's been sequential decline from September to October to November to December, be it Hero MotoCorp, Bajaj or TVS Motors. So there making money won't be very easy. However, still there are two stocks which look fairly good and reasonably placed, where the numbers has been far stickier than the others in the life on a month-on-month basis as well. And those are Eicher Motors and Maruti. So fairly to put it, very squarely, we are focusing still on large cap ideas as of now, till the budget is rolled out and we get a texture of the flavor of earnings for the Q3 which are about to be rolled out.
Okay, now you're seeing a 5% cut on Manappuram Finance as we speak. RBI has raised objections to Bain Capital's plan to acquire a controlling interest in or controlling stake in Manappuram. That is significant because the rally in the stock price, if you can please pull up maybe the 6-month chart, you'll get a sense, or maybe even 12 months, you'll get a sense that the rally is not just gold loan led. It's led by the fact that there's going to be a management rejig. Maybe the 12-month chart may be better. There you go, from 180 to the current 290 levels. That entire rally is not just gold loan led. It's also led by the fact that there's going to be Bain Capital who's going to come in, leverage on the business. But currently, there are objections. We'll get you more with regard to what is it that Bain is exploring a phased divestment in Tiger Capital to address concerns about the Manappuram deal. So there is going to be an addressal of that concern, but of course, for the moment, you're seeing that knee-jerk reaction, 5% lower on Manappuram. Dharmesh, what do you make of this? It's significant, right, in Manappuram's case. Is this an opportunity, if at all, to buy into something like a Manappuram? Because it seems like the deal will eventually go through, and that Bain will likely repair whatever it is which RBI's concern is.
Yeah, Dr. Harsh, I mean, see, as far as gold loan finance is concerned, now everybody is into that. Even banks are aggressively pursuing this business for the likes of, say, Federal Bank and all. But we will still go with Muthoot Finance as far as the gold loan finance business is concerned. Manappuram, I think, was in our spot because of their microfinance issues earlier. And this is a new specific correction which we are seeing, to which I totally agree with you. But I have my own doubts on the entire gold, because to my mind, I think the entire this bullion space, gold and silver, is now hitting some sort of a ceiling out there, and we can see volatile correction happening out there. So if 10% kind of a correction happens going forward, say next 4 to 6 months, then your LTV you naturally gets reduced. And the option with gold financer is that if the LTV is getting reduced, to the borrower has either to repay or furnish more gold. That would be a very difficult and a volatile situation for these companies to deal with. So that one has to keep in mind. So from here on, any buyers on a pure gold play NBFC, one has to be careful with. So what we are suggesting is a hedge kind of a play, where you also have a gold portfolio, but at the same time, other classes make up the chunk of the lending book, and there I think Federal Bank stands a better chance.
Federal Bank. Okay, now this is, of course, sources to agencies, but the stock obviously has taken a beating. It's taken a knock, 6% lower. Kunal, on charts, how is this one looking?
So on the back of gold prices, Manappuram Finance was looking quite attractive. In fact, the stock was perched at a fresh high about the 300, 310 odd mark. But I think this would again dent the prospects for the stock in the near term. Like what happened for BHE yesterday, that sharp round of volatility generally discourage traders to try and initiate fresh longs, even though these stocks are down 5, 7, 10%. in individual cases. I think Manappuram Finance just hit a low of 278, and from there the stock recovered. So maybe I think we're now looking at 290-ish. Thereabout is a new pivot point for Manappuram Finance. Would not initiate a buy because there are two aspects to it. One is that the market volatility is still hitting the short-term traders, and the other is that with such kind of news flow impacting the stock price, it's going to discourage short-term traders to try and build up long positions. So I think on either of the cases, I think one should stay away from the stock in the near term.
Okay, so that's the take coming in on Manappuram Finance on the charts. On that note, time for a very quick break. On the other side, we're going to be addressing more newsmakers today. So stay tuned and we'll be right back.
Welcome back. And more pressure, in fact, on the index continues. We're 0.8% lower. Just to kind of give you context and perspective, some of the big losers of the day: Adani Enterprises down nearly 3%, Shriram Finance down 2.5+%, NTPC down 2.5%, ICICI Bank, which has been the standout play all through this week, is also down 2% odd. In fact, the Adani ports, or rather both Adani Group stocks, down 2% odd, and Adani Ports also seeing some bit of pressure, along with Jio Finance, Bajaj Auto, and just the advanced decline skew is very sharp on the Nifty 50 index. That's not what we were seeing in the morning, but that seems to have shifted quite dramatically as the day has progressed. 40:10 is what on the Nifty 50 index the breadth looks like. 1.5% higher on an Asian Paints though, that one's standing out, and so is an ONGC. Let's bring on board Rajesh Palvia, get more context on what's playing out and how he's viewing the index. Rajesh, talk to us a little bit about that. How are you viewing the Nifty and the kind of move that we're seeing today, the kind of pressure, and just the kind of breadth that we're seeing? It's another very difficult day, third straight day, what it means in the larger context of things.
Good afternoon, Harsh. Good afternoon,
afternoon.
everyone. So it's a strong supply pressure which we are witnessing in the market since last trading session. In the previous day itself, we have seen short built up was there. Aggressive short was opened in the previous day itself, and today follow-up selling. And in this follow-up selling, we have decisively broken the 50-day moving average support area also. Even if we analyze on the weekly chart also, now Nifty has broken its upsloping channel also on the downside. So it's a kind of serious damage on the trend of Nifty for near term as well as for the short term perspective. So until the Nifty not able to regain about 25,900, which is very far from the current level, the trend is likely to exhibit on the bearish side, and we could see furthermore continuation of down move. And possibly now Nifty is heading towards its next support area of 25,500. That's the next important moving average for the Nifty on the downside. So that level we could see in the continuation of this down move. Bank Nifty is also struggling to hold out the support area of 59,300 400 zone based on the put base. But the way the broader market is sulking, I think here also we could see furthermore supply pressure, and possibly Bank Nifty can go down towards 50-day moving average, which is almost around 59,000 level. So I think both indices are under pressure, short build-ups are there, and we may see furthermore downtick for Bank Nifty. Could be the next level could be around 58,700 on the lower side, until the Bank Nifty not crosses above 59,600. So looking at the overall scenario, we recommend here to go short. Even in minor pullback also you can go short, as trend has turned on the negative side, and we could see furthermore follow-up selling.
Rajesh, amid a market like this, since you're recommending a short, is that a call that you have on some of the stocks as well? Are you placing any fresh call or any fresh short ideas?
So I think the fresh short which we look at on the Bharti Airtel stock has broken the important support area. Stock is now slipped below to 50-day moving average. The fresh short built up is there. So I think Bharti Airtel can go down further. On the downside, 201980 would be the next target. So one can go short with stop loss of 2060. Another stock where we are focusing is Geo Finance. Here also we have seen that stock again failed to cross 302. That is the major challenging level for the stock. And looking at the near term weakness, we believe that this stock may also go down, and possible down move towards 278, 275 we could see. So one can go short Geo Finance also with stop loss of 294.
Okay. Let's switch focus though. There's plenty happening on the macros as well. The US Commerce Secretary says trade negotiations with India have stalled after Prime Minister Modi did not directly engage with President Trump, calling the deal Trump's to close. The US then moved ahead with Indonesia, Vietnam, and the Philippines, striking deals at higher rates, leaving India trying to re-enter talks after others were already finalized. Let's listen into what he had to say.
Tracks and set the whole deal up. But let's be clear, it's his deal.
Yeah.
Okay? He's the closer. He does the deal. So I said, you got to have Modi. It's all set up. You have to have Modi call the president. And they were uncomfortable doing it. So Modi didn't call.
Wow.
So that Friday left. In the middle of the next week, we did Indonesia, the Philippines, right? Vietnam. We announced a whole bunch of deals.
Malaysia in that period.
So we did these whole bunch of deals. So that's like,
that staircase.
and they were at, and because we negotiated them and assumed India was going to be done before them, I had negotiated them at a higher rate. So now the problem is the deals came out at a higher rate.
Right.
And then India calls back and says, oh, okay, we're ready. I said, ready for what?
All right, Kunal, there's just been such a lot of back and forth that's happened with regard to this deal, and you've been with us all throughout. So I'm trying to get a perspective now. Is this deal just a sentimental positive for markets? And do you believe that if a deal were to come through, we could see a short-term bounce, if at all any? Do you have a perspective on that?
Yes, Harsh, and we've seen this over the last 1 year, the kinds of ups and downs the markets have seen on the back of whether the deal is going through or whether it's not. One thing is very certain, looking at the market reaction, that this deal is extremely crucial for our markets our performance over the medium to long term. Now look at it this way: there are two metrics to look at our markets. One is on the back of global underperformance, which we've gone through the entire calendar year 2025. And remember, calendar year 2025 was not a torrid year for many global markets. In fact, there have been markets like Korea, there have been markets like Japan, etc., which have done exceptionally well. So, clocking returns of 75%, 20% respectively for many of the indices, compared to our markets, which have done literally abysmal kind of returns, single-digit returns in that sense. So in that parlance, yes, the deal is very, very important for the markets to start getting back into that zone where the underperformance could get caught up into. Now, the second and the most important part is you look at the tone of the market in the last couple of days. The moment there was a whiff that there could be some additional tariffs which could be laid, there could be a zone why the Indian tariff, India-US tariffs have stalled. You've seen the reaction for the index. Markets are not just eager to try and book out positions on the long side, but they are now also very, very eager to build positions on the short side, expecting that the deal may not fall through even by the month of March, which was projected, I think, a couple of months back. So that context is where the market remains on an overhang basis. Of course, it's a strong sentimental, new sentimental impact for the markets. But hey, the most of the market trends and especially the knee-jerk market impacts generally happen on the back of sentiment before the data starts to prevail. So as of now, till the time the deal is not clear, or there is no clearance in terms of the air, what and how the deal is going to shape up, the markets will remain into that zone of uncertainty. And that's why you would probably want to see the markets going into a more corrective phase over the near term. So that deal is very, very important for the markets in the near term to not just get back into more stable trend, but to also try and cover up the underperformance for the entire calendar year 2025.
Okay. Kunal, where do you see in terms of a bottom where the Nifty is concerned? We've already seen a fair bit of pressure. Do you believe there is still some downside risk left on the index?
See, a classical way to look at it is that Nifty by itself will not move. Nifty is the sum of total parts of the entire components of the Nifty 50. Now, one of the points which I was making yesterday late evening and today morning also, that you look at the list of stocks which are falling below their 200 moving averages. Case in point, HDFC Bank in the last 1 week has fallen by 5-7%. The stock has fallen below the 200 DMA. Reliance Industries has fallen below the 200 DMA. You look at names like IOC, HPCL, ITC, Trend. These stocks have fallen below their respective 200 moving averages. So as the day goes by, the list of number of stocks which are falling below their respective 200 moving averages on the Nifty 50 basket itself, that list is increasing. Now, Nifty is the sum total parts of the entire complex of Nifty 50. If you have major number of components which are falling below their 200 moving averages, it's bound to be a point that the Nifty also retests the long-term moving average. To put this into numbers, the 200 DMA for the Nifty is at 25,100, 140 thereabouts on the index. So I'm not saying that the Nifty will head to that level, but there is always a higher chance that if more the number of stocks on the large cap or the Nifty 50 basket, if they keep falling below their 200 moving averages, there's bound to be a point that the Nifty will also try and succumb to that selling pressure and retest those levels. So if you ask me, I would believe that if over the next 1 or 2 days, there is one more round of additional pressure in terms of selling, very high chance that the Nifty may test 25,150 also.
Okay, on that note, time to slip into a very short break. On the other side, we're going to be breaking down the earnings of Elecon Engineering, a stock that's under pressure by a lot, almost a 16% cut coming in on the stock today. So we'll get a view on that as well. Stay tuned and we'll be right back. Back with closing trades, and like we told you before the break, let's delve deeper into the earnings of Elecon Engineering. The numbers came yesterday post-market hours, and why we're mentioning this stock right now is there's almost a 16%, 15.5% cut on the stock as we speak, because it's been a very weak Q3 for Elecon Engineering. Let's look at the numbers. Revenue has come in at 552 crores, which is up only 4.5% less than that, rather 4.3 to be precise, and much lower than what the street was estimating. Similar is the case for net profit. It's taken a beating of 33% on a year-on-year basis at just 72 crore rupees. So very weak show over there as well. EBITDA has taken a knock of 23.5%, but it's actually the EBITDA margins that have seen some massive erosion at 19.8% compared to 27% on a year-on-year basis. So the EBITDA margins have also come down. It's come lower from 27 to 19%. So that arrow will come lower. You have, in terms of key highlights, the subdued quarter. This one has been for Elecon Engineering due to weakness in gear division. EBITDA margin has fallen due to the mix and cost pressures. Margin pressure from flat execution in the gear divisions. Gear has been the pain point for the company this time around. The gear revenue was absolutely flat, up only 1.5% on a year-on-year basis on the back of delayed first half order inflows. EBIT margin has seen a drop over here as well. The order book, they say that in Q3 the intake was at 701 crore rupees. Total order book stands at 1,372. Management says that they're confident on revenue and margin recovery. They're focusing on overseas expansion, targeting 50% global revenue by FY30, and they're also making strong investments in manufacturing, R&D. They have strong visibility from domestic capex in steel, power, cement sectors. That's the thing that's the guidance that they have given for Elecon Engineering. But that management commitment and the outlook has not given the street a lot of respite when it comes to this stock. The stock is seeing a cut of 15.5%. Dharmesh, your take on telecom engineering and this overall sector, do you believe that other peers in this space might also see a similar quarter three?
It looks like, I mean, if you go by Q2 numbers, they got a very good set of numbers. Electrical engineering numbers are pretty bad, going by the Q3 numbers which they have updated. And this is into power transmission and equipment, material handling equipment, gearboxes, and all. So these stuffs which they make are not very high end. They are all medium to low end kind of a stuff. Not very high technology is needed out there. So the other fear which is plaguing the market for all such power equipment manufacturers is that if Chinese companies are allowed to get 100% route into it without technology transfer, then it can be a big challenge for them to maintain the pricing at which they are selling to Indian domestic consumers. So but that's another challenge. But I think that's still not freezed. But we have to see how it rolls out in the view of the complex geopolitical situation in which we have been functioning. So that is another factor which is, plaguing down or having a selling hit on all the power related stocks. But yes, the other point is they are still very expensive. If you look at, say, Hitachi Energy or a Siemens or ABB or Cummins India, they are not, fairly valued stocks. So they are all trading above 80, 90 PE multiples. Elecon is at 20, 21 kind of a 1 year forward PE multiple. But this kind of a growth trajectory, if you're not seeing 4-5% kind of a growth, then definitely there's a challenge for them. So our advice as of now is to stay away from the sector. I mean, 15, 20 days would be very critical for all these sectors till the budget is done. There you can get some kind of a clarity on how the government policy is going to pan out for next year in light of what is happening with India, relation with US and the other counterparts.
All right, Dharmesh, thank you so much. We'll let you go on that note. Thanks so much for joining us this afternoon and giving us all of those views. And viewers, time for a special conversation with regard to IT, because you'll have those IT sector numbers starting to trickle through on Monday. And therefore, what we want to do is try and give you a perspective on what to expect. And we have Sandeep Agarwal from Sovilo Investment Managers, who's coming in to speak to us about exactly that. Sandeep, this time, firstly, thank you so much for joining. Good afternoon. This time around, with regard to Q3, how are you expecting or anticipating the numbers to be?
Yeah, hi, good afternoon, and thanks for having me on the show. So, this quarter, as you know, that, there is a December month where there are furloughs in the manufacturing side. And because of that, the working days are itself low. So, expecting anything big in this quarter from any company is little difficult. So this will be kind of modest quarter with flattish kind of growth for the large names. And also in this quarter, there is no big impact of any kind of, cost escalation. So we don't even see a big decline or uptick in the margin. So in my view, this is a quarter where commentary has always been more important rather than numbers, because if you see in the IT world, first week of Jan is where, budgets from clients starts getting communicated to the vendors, and I think some color of that most of the management should be able to give. Although I believe that we are still away from any good growth numbers coming in from the sector for next 12 to 18 months, primarily because the market where these players are there, it is a mature market. The space is very mature, so expecting a big growth is very, very tough in the sector.
Okay, and Sandeep, talk to us about the kind of deal wins that you're expecting to see from some of the large cap names like TCS and HCL Tech. Let's talk about them first, since they're one of the first ones to kickstart the earnings season next week. How do you think their deals have shaped up? Has there been any ramping up on that front?
This quarter, we have not heard any big deal announcement, honestly. So I think even on the deal front, the same book-to-bill ratio of slightly less than 1 or around 1 is what we are expecting. And I think most of the companies will be in that range. See, the challenge which has happened is that, a lot of these small and mid-sized players, they are participating now in every deal. And that is the challenge these large caps have been facing in last 3-4 years. So if you see the top 2 Indian IT players, the return of last 4-5 years on stock is almost zero. And the reason is that, earlier they were only participating. In fact, I remember when I used to cover as a sell-side analyst, there were many deals in which only Accenture and TCS were participating. Then there were very few deals in which even Infosys was allowed because of the size of the deal. Now, what has happened post-COVID due to digital disruption and shorter execution period, the smallest of small companies also allowed. So the criteria have completely changed. So the edge of balance sheet and size is completely gone, and that is the reason large caps have been languishing in terms of growth. The mid cap and mid caps are languishing in terms of growth to the small cap. So it has become a very democratized world. All deals are now up for everyone. Whoever can execute better and at a cheaper price and quickly will get the deal.
Okay. Sandeep, what should one make of the AI play that's coming out of IT? We had one of the large IT players disclose that it's going to be roughly 5% of the deal wins that they have. But in your opinion, will all the other IT players also start disclosing this? And will the income statements or the profit and loss accounts of the companies look materially different, say 3, 4, 5 years down the line? Will the number of hires come down? Will the top line remain as is? And will margins go up? How should one see the environment as it changes?
So let me put it very clearly here that you won't see much margin decline in the sector for next few years because the number of employee numbers will keep on going slightly down, or the revenue growth will be higher than the employee growth for sure, and that we have seen in last 2-3 years also. It will further accelerate. That trend will continue. Because of that, your percentage of margin will not fall, and margin growth will not be inferior to revenue growth, which used to happen when due to wage hike impact. Secondly, you also have some tailwind of the currency. So I think margin, I am not so much worried, but this is a sector which is X growth now. So I believe that this is a sector where you can expect 7-8% kind of EPS growth for the large names, 4-5% kind of revenue growth for a longer term of period, and for mid cap another 3-4% additional, and for small cap further 3-4%. So it is a sector of 8, 12, and 16% PAT growth at best, or 5, 9, 10, and 13-14% revenue growth at best. This is the way I see the sector.
Of the pecking order in where you think the companies could do well, if you could rank some of the larger cap names for us in terms of what could do well?
So I would put it like this, that ER&D will definitely do better, but you can't buy ER&D because the stocks are obnoxiously expensive right now. So if they correct little bit more and they come to reasonable peg ratio of 2.5 times, so I will give you a clear formula that you should prefer small cap over mid cap and prefer mid cap over large cap. That should be the order. So it is a reverse order because of the changing dynamics of the industry. Second, it is very clear that you have to go by PEG ratio and not PE ratio, because PE ratio is completely misleading. There is no growth. So when you do the PEG ratio, you will be surprised to know that what is looking expensive in PE ratio terms is not actually expensive. So PEG ratio is the right measure to look at, and that's the reason I'm saying small cap over large, mid cap, and mid cap over large cap. And within the practices vertical, I will prefer ER&D companies over typical IT services companies.
Okay, all right. Rajesh, I wonder if you have a view with regard to IT and where this one is headed as an index, and what are your top picks within this pack?
So Nifty IT is still struggling to come out from the resistance zone. We have seen multiple attempts for Nifty IT index, but still there is no sustained move taking place in Nifty IT index. On the higher side, 38,300, 400 is the immediate resistance area for Nifty IT, which is almost near to this 20-day moving average. So until Nifty IT not able to take out this 38,300, 400 zone on a weekly closing basis, we could see some more consolidation in the range of 37,300 and 38,300. The 1,000-point range would be there. If I have to select some of the stocks from the Nifty IT pack, so I think Coforge that we are focusing, though there was corrective move in last couple of week, but looking at the long-term structure, stock is available near to its important support area, which is placed at around 1600, 1620 zone. So until the stock is not breaking below 1600 level, I think there is a possibility that we could see some reversal from here. And once stock able to take out above 1740, 1750, we could see short covering action, which can take stock further higher to 1800, 1850 zone also. Again, from the large cap IT space, I think one can focus on stock like HCL Tech. Again, there was correction, but still, if I compare with other large cap IT, HCL Tech is well placed. And looking at the near term, short term structure, stock is comfortably holding 50-day, 20-day moving average. So here we could see some recovery. Once stock crosses above 1720, there is a possibility of 1800 target for HCL Tech. So here one can deploy some long trade with stop loss of 1570.
Okay. All right. So that's the take with regard to IT. Sandeep, I'll request you to wait by. I know that we've called you for an IT chat, but now that you're here, I'd like to pick your mind on another couple of sectors as well. So stay with us. What I will do is, though, take a mandatory break. But before that, can India realistically catch up with the US and China faster than expected? In the latest episode of The Interview, former RBI Governor Raghuram Rajan says that the answer lies not in slogans, but in deep reforms, especially in education, skilling, and human capital. Here's an excerpt of that chat. We'll see you after a very short break.
When I see some of the plans that states have for growth, it's always we need more chip engineers. Yes, you need more chip engineers. You need more R&D. We talked about that in the beginning of the program. But we need many, many more sort of moderately skilled people, because that's where the jobs are. And that means both skilling in schools, but also reorienting our skilling institutions, the ITIs, but also new ones. There are states that have done a good job. Orissa skilling program has been very good. And we can sort of share these best practices and improve. But I think the jobs are a problem if everybody's trying for the IAS, in which, there are a few hundred jobs, or if everybody's wants a cushy government job. There are not enough government jobs. That's not going to happen. But we need to create many more private sector jobs, and that means not just the big companies, formal jobs, but also self-employment in areas like the urban services that we need so much of.
15 to 30 years for India to reach the economic scale of the US or China. What is the single most critical structural reform that could meaningfully shorten that timeline, according to you?
First, just do the math. I mean, this is not a deep scientific estimate. It's just looking at their per capita GDP and asking how long it would take to reach that. If you do the math, you will arrive at similar numbers. That to get to Viksit Bharat, whatever that means, because there's a wide range of meanings applied to what Viksit Bharat means. But if
in association with Bank of Baroda, play the master stroke with Bank of Baroda.
शिव प्रसाद जी को बीमारी के कारण 15 बार हॉस्पिटल में एडमिट होना पड़ा। पॉलिसी बाजार की टीम ने उनका लाखों का क्लेम अप्रूव करवाने में पूरी हेल्प की। पॉलिसी बाजार पर 1 करोड़ का हेल्थ इंश्योरेंस सिर्फ 550 रुपए महीने से शुरू।
Whenever I ate ice cream, I felt a sharp sensation in my teeth. It kept building up. I kept ignoring it. Then the dentist told me that the upper layer of my teeth had worn off, and nerve endings are getting triggered by eating this cold ice cream. My dentist recommended using Sensodyne daily.
Sensodyne goes into the teeth and calms the nerves.
I can now eat my ice creams. I can now have ice in my drinks. Sensodyne works.
Presented by IDFC First Bank, always you first.
AU सेविंग्स अकाउंट में मिलते हैं अमेजिंग बेनिफिट्स, पेपरलेस बैंकिंग एंड हायर इंटरेस्ट, वो भी हर महीने।
मनी 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 एवरी मंथ।
सोच बदलो और बैंक भी।
Across the board over the last 3 trading sessions. What is it that you're liking? What is it that you're buying in 2026? What themes are likely to work? I know that you're not restricting yourself to being just an IT specialist or IT sector specialist. So talk to us about how you're viewing markets as a whole. Try and give us a sense of that.
Yeah, so thanks for the question, because I do track IT, but very little. Now we have a PMS, so
that's true.
We manage and we overview all the sectors. So I think there is a consensus, near consensus, that this is a year of financials, and I also concur to some extent to that. And the reason is very simple, that the interest rates are going to go a little more down from here as well. While it impacts in near term the NIMs, but in longer term it does propel the credit cycle to some extent. So that is one reason. Second, the most important reason, if you see, always the banking sector, when it has not done well, is primarily when there is a increase in delinquency, there is increase in credit cost, and we don't think that we are anywhere near to that situation in next few quarters. So I think that is one sector which will definitely do phenomenally well, and if it gets some support from the growth on the GDP front, because that will mean more demand for money for both capex and working capital. In that case, even it is the best proxy to play even the economy. So I think that is one sector which looks most secure, and I think a lot of money will be made in the large private banks now from here on. So that is something which we are liking a lot. Second is the intermediary space, the capital market intermediaries. We believe that the penetration levels are very, very low, and while there could be questions around the expensive nature of the stocks, but in long term you will make a lot of money. The growth will be phenomenal, and the peg ratios are not as prohibitive as the PE ratios. So we are looking at peg ratios, they look quite good. And the third space, I think, which can do better is the manufacturing. It is just a matter of time when private capex picks up, and once that picks up, then a lot of this capital goods industrial manufacturing side will pick up in a big way, because we cannot afford to be only services industry. And I think a lot of work on the manufacturing side have happened from the government through PLI scheme and all. And I think there'll be a big boost to manufacturing with maybe some pause, but it will come back. So these are the three spaces where we are very, very positive.
Okay, so that looks good. Sandeep, your take on the metal counters and the kind of massive profit taking that we're seeing on metals. Is it largely because of the way the commodities have run up, and also the stocks have also run up, and that is why there is some profit booking, or are you seeing some underlying fundamental weakness over here?
No, so what has happened is, if you see last 5-10 years, because of the focus on the renewable, the old economy, things have taken a side track, and that is the reason you are now suddenly seeing shortage of all the commodities, right from gold, silver, copper, industrial metals, and everything. And I think that shortage has popped up the pricing so much, but I think what happens is that people are only seeing one side of the story, that there'll be huge demand and all this thing. You also have to remember that in this kind of uncertain geopolitical scenario, and if the prices are prohibitive, then the economics works in both ways, that because it is highly profitable, lot more supplies will start pouring in, and at the same time the demand will go down, because the end use of that is finally in the industrial side, X of gold. So there, if the prohibitive cost will reduce the demand. So I think people have to take a very, very rational view. We generally don't prefer to have a percentage beyond 3-4% in our portfolio for metals, because we cannot afford to have such wild moves, and so we restrict to them when there is peak pessimism, and at the current situation when there is good optimism, we will be very, very cautious.
Okay. Kunal, with regard to metals, that pack, does it interest you at this juncture?
I think selectively, Harsh, because at current levels, for example, Tata Steel at 170, 75, 78 levels, when it's trading right now, it's 10 points off from a recent swing high. You're looking at Hindalco shaving off, I think, around 4% to 5% from its recent swing highs of around 950 thereabouts for the stock price. So there are those pure names which are looking a little bit more better placed than what they were maybe a week back or maybe a couple of weeks back for these stocks. So I think in that sense, maybe a buy could be originated into these stocks. But then, I also believe that it's got to do with the overall tonality of the market, which still at current levels and looking at today's market is still on the uncertain side. So you have to be very, very specific with the kind of trades which you pick up. Not all stocks and all trades, even though they've been doing very well for themselves for the last few weeks, few months, they would warrant a buy because the markets have changed its tone. So that, I think, overhang still remains. So if, for example, next week we start to see some recovery building up, then yes, metals could be one of the favorite sectors in that sense.
Very interesting. Okay. Sandeep, we've spoken a bit about IT, we've spoken a bit about metals as well. What about consumption? How are you playing that theme? Auto has done so well. I remember or recall reading SML Mahindra's numbers. They were just fabulous numbers, such strong growth across the board. Exports, of course, lagged, but domestic growth was just extremely strong. How do you play auto in particular, and how do you play consumption overall?
So as far as auto is concerned, now we are shifting our focus from direct auto play to auto anchors, primarily because I think the large part of the story for auto is over now. What is left is compounding. So the big delta of 60, 80, 100% return, that has already been done. So if you see, for example, Maruti, it has moved up from 11,000 to 17,000 this year. Before that, from 8,000 to 11,000 took 4 years. So that, if you also see the two-wheeler numbers, 2019 numbers, it has come back in end of 2025. So the thing is that, I think the big delta in the auto sector is over now. What is left is compounding story, and there is a GST boost to it. So for people who are looking at 20-25% kind of return, maybe, the direct auto exposure makes sense. We are a small fund, so we are okay to, buy little smaller names. And so we are much more focused now on auto anchors, and particularly auto anchors in the CV side, because we believe that CV cycle has started picking up. So that is one way we are playing consumption. Second, we are playing through some contractors in the FMCG space, but we are avoiding, the direct FMCG names because we have a very structural view that the population growth rate has been consistently falling and the fertility rates are going down. So the volume growth in this industry will be little challenged. So we don't want to, be in an industry where only price hike drives the industry. So we will avoid direct FMCG. We will be better off playing it through, some of the auto hangs and some of the quasi names, even some auto dealership, because it suffices both the condition of premium play and auto to some extent. So we would play through quasi premiumization, quasi proxies to FMCG and not direct FMCG because we believe it is a low growth industry similar to like IT maybe.
I understand. Kunal, let me take or pick your brain on a couple of counters we've been talking about for the last couple of days now. And HDFC Bank, a Reliance, what do you make of those moves today? HDFC Bank, just weaknesses, it's getting weaker and weaker. Yeah, today as well in the red, 0.7% lower.
Yeah, it's definitely a concern for the markets, Harsh. But there comes a point where after 4 days or 5 days of consecutive selling, that these stocks get into a process of a bounce. It's a natural process of ebb and flow which happens into stock markets or into stock prices, where after a phase where the stocks get beaten down, for a short period, there is a consolidation or slight recovery on the individual stocks. What matters over here is the second leg of trend which shapes up. So, for example, assuming if HDFC Bank, I would believe, could probably go into a mild recovery phase. So, assuming the stock at 940, 43 odd mark bounces back towards say 965, 975 kind of a zone. Now, how the market shape up at that kind of a time frame or that kind of a zone for HDFC Bank? If the tone still is extremely on the negative side, then the second round of sell-off could take the stock not just back below the 940 mark, but even further and potentially even challenging towards the 900 levels. Same is the case with Reliance Industries. The stock has ebbed off more than 120 plus points in just the last, I think, 4 sessions or 5 sessions approximately, and it's now broken even below the 1500 kind of a zone from 1610, 1620 mark, which the stock had hit at those points. So in that context, the stock seems to be a little oversold on the short-term charts. There could be a process of a near-term bounce, but that bounce generally gets sold into if the market tone still remains to be on the negative side.
Okay, very interesting. What about an Asian Paints today standing out in trade, Kunal, on charts? How is that one looking?
Yeah, this is a completely different chart, Harsh, and it's good that you pointed this out because Asian Paints has been a huge underperformer for the last 3 or 4 years. You look at 2021 or 22 thereabouts, the stock made a high of 3,000 approximately for itself, and from there the stock had fallen down to 2,300 at one point of time, so down by almost 30% for the stock price in the span of the last 3-4 years. Mid of 2025, when the stock recovered from those 2,300 odd levels, we saw a very strong recovery for Asian Paints. Now, that set the tone apart for the stock price that we are looking at the stock as covering up a major underperforming cycle which had been going on for the last 3 to 4 years. So, I would sense that Asian Paints by itself can move in its own trend, devoid of how the overall benchmark indices or the market sentiment could prevail. You might have 1 or 2 days of an odd hit into the stock price, but largely I would believe that Asian Paints could be a very good candidate for a buy on dips. My expectation is that potentially for the calendar year 2026, there would be a point where the stock may cross levels of even 3,000 to potentially 3,200 as well.
Wait for that bounce on the Asian Paint stock. That's what Kunal's calling for. But my colleague Charu Singh caught up with the managing director and CEO of Ashok Leyland, Shenu Agarwal, on his role and expectations from the government's EV policy. Let's listen in to a slice of that conversation.
We are already in the process of supplying more than 900 buses to Delhi government for the city of Delhi. And I think, right now the noise is more in metro cities like Delhi and Mumbai and Bangalore, etc. But I think every city, every state government will have to consider EV as the future. And which is happening because, these mega incentives that have been provided through CSL for adoption of electric buses in the states, government coming up with PLI scheme for electric vehicles, government coming up with PLI for battery cells. government coming out with several other promotions, incentives, etc. I think this EV story is bound to happen. And you wouldn't believe that Ashok Leyland in 2011, when nobody actually knew about EV or electric vehicles, Ashok Leyland had developed the first prototype of the electric bus, right? So our company's DNA is innovation, and we always kind of believe in doing things ahead of time. We are pretty good at forecasting the trends in the future in the market, especially in terms of technology. So we do want to take a major step when it comes to clean and green mobility.
So if I ask you, for example, 3 points that you think the industry is most keen about while, conversing with the government, especially, for example, in Delhi scenario, if we take, for example, for the EV policy, what do you think are the things that you are looking for, not individually, but also as an industry?
Yeah. So see, I think there are 2 or 3 important points for government to consider, whether it's a state government or a national government. Number one is right now the prices of EV buses and trucks is about 2.5 to 3 times that of a diesel. So this creates a lot of impediment in the mind of the customers because see, affordability also matters. While I agree that the operating cost of an electric bus, for example, is less than half of that of the diesel, but like if you pay 40 lakh rupees for an electric bus, for a diesel bus, and you have to pay 1 crore for an electric bus, so people would hesitate, customers would hesitate, even knowing that per kilometer basis, electric vehicle would be much better. So I think what government can do is to take some measures to decrease that anxiety or hesitation in the minds of the customer to adopt EVs. Like some incentives maybe upfront, some rebate on the road tax, rebate on the tolls. There are several things that government can do. That is one. Other is that government should really promote localization of EV supply chain.
Okay, and onto an ET now, budget exclusive. The Labour Ministry has prepared a proposal to hike the APFO wage ceiling. Prakash is here with more details with regard to that.
Well, we are learning that the Labour Ministry has prepared a fresh proposal to hike wage ceiling under EPFO, which is currently at rupees 15,000 per month to rupees 25,000 to 30,000 per month. A fresh proposal has been sent to the Finance Ministry, which is likely to be announced in the upcoming budget. A very significant development coming in. In fact, sources suggest that the earlier proposal could not be accepted by the government because of regular opposition by employer associations. They were not happy with the proposals, and therefore the earlier proposal was put on the back burner. Now sources indicate a fresh proposal has been prepared by the Labour Ministry, which has been sent to the Finance Ministry, which is likely to be accepted. Along with that, sources also indicate that this time wider consultation has taken place with the employer unions and the trade unions. Along with that, this move is also important following the Supreme Court directive to the central government to revisit EPFO wage ceiling. It is important to note that the EPFO wage ceiling has not been revised since 2014, despite the fact that there is significant hike in minimum wages in several states. And therefore, after taking all these factors into consideration, government this time has prepared a new proposal which has been sent to the Finance Ministry as a part of budgetary recommendation, which is likely to be accepted. Back to you.
Okay, thank you so much for that, Prakash. If I can come very quickly to you, Sandeep, with regard to the pharma space, is there a preference you have within pharma chemicals, and especially in chemicals? Are you expecting to see a turnaround anytime soon? Again, every quarter, we come and chat about this. When will the chemical cycle turn?
So on chemicals, we are not yet positive while the stocks have gone through massive correction both on price and time front. But we believe the China oversupply constraints are still there, and we have to see for real, numbers to kick in every 3 or 6 months. Whenever there is a reduction in inventory and there is some fill up of inventory, the stocks do move up 20-25% and people start calling it the bottom of the cycle. I don't think that is reality. In my view, there are some green shoots in the agrochemical side, but again, there the stocks are little expensive. But other than that, we don't see any green shoots anywhere. On pharma, we are very constructive now on the beaten down names in the generic space and some of the branded names. So we are not chasing CDMO names anymore because they have run up too much and they are beyond our comfort zone. But some of the generic names which have some impact of Revlimid in the past and which will still undergo challenges 1 or 2 quarters, they have become very attractive on volume and value, and also some of the API players look very, very attractive. So we are very keen on evaluating those names at 15, 16 times forward earnings. We are okay for underperformance for 1 year in that space, but we believe that after 9 to 12 months, definitely these stocks will give outsized returns, and the margin of safety on valuation is very, very high.
Okay. Sandeep, thank you so much for joining us, being very patient, staying back and speaking with us. Thank you for your time. And let's take it across to Snehi with regard to how markets are shaping up at close. Snehi.
Oh, well, absolutely. It's been a very weak, not only trading day, but the trading week. Ever since Monday, we've seen 5 consecutive sessions of close in the red. 0.7% cut is where we are touted to close at 25,686. So yes, even below the 25,700 mark, which was the ultimate support level to watch out for, and we've shattered even that. So that's on the Nifty 50. Sensex to 0.7% lower. Nifty Bank is also absolutely in tandem with the Nifty. 0.7% lower coming in on the Nifty Bank as well. Although the Nifty PSU Bank, some of those stocks have done well. It's a select pocket of stocks, but they've done well, and we'll get to that in a minute. Just take a look at the advanced decline ratio. Similar ratio that we have seen yesterday, almost a 1:4, 1:5 move on the advanced decline ratio. And on that note, let's pull up the broader end of the market. Nifty mid-cap seeing pressure of about 0.8%, but it's the Nifty small-cap end of the market that is absolutely battered in trade, and more than 1.5% of cut that we're seeing. In fact, now it's inching closer to the 2% mark on the Nifty small cap index as well. Some gainers on the Nifty 50, a rare group of stocks today. Asian Paints, HCL Tech ahead of its earnings. ONGC, BEL, Eternal, Dr. Reddy's, they have been the top performers, so they have done well. On the flip side, you have some cuts coming in on Adani Enterprises, NTPC, ICICI Bank, Geo Financial. These are some of the top losers on the Nifty. Let's talk about what the sectoral moves have been. Like we said, Nifty IT has been the top sectoral gainer in an otherwise baited market. You have some stocks in focus on the back ahead of their earnings. Remember, you have TCS and HCL Tech earnings beginning. Before that, you have Coforge, HCL Tech, Infosys, Tech Mahindra. These are some of the stocks that are showing a good move before those earnings. Nifty PSU Bank, select stocks doing well like Indian Bank, Maharashtra Bank, Union Bank and Bank of Baroda. These are some of the stocks that are doing well. After this, everything is trading in the red with big cuts coming in on the Nifty realty space. More than 2% cut coming in on an intraday basis alone, with names like Godrej Properties down about 5% today, Anantraj, DLF, Lodha, Oberoi Realty. So the sustained pressure that we've seen in the real estate side of the market, that continues to persist. From the Nifty 50 group of companies, Nifty 500, pardon me, Nalco has been the top gainer on a day where we've seen massive profit taking in some of the metal stocks. Nalco has done well. You've seen Leela Palaces on the back of a brokerage note, Hindustan Zinc, Oil India, that has done well. On the flip side, Elecon Engineering on the back of a weak Q3 numbers, 15.5% cut. IEX on the back of that market coupling case verdict coming in, almost an 8% cut over there. Of course, more updates on that front. Manappuram 7.5% lower. Force and transformers and rectifiers too deeply under pressure. So that is how we're shutting shop for the day and for the week. Back to you, Harsh, in the studio.
Thank you so much for that, Snehi. Well, that's how we're shutting shop. It's another tough day of trade. Kunal, how do you assess the day as well as the week gone by?
We just say thank God it's Friday, Harsh, that the markets finally taken a pause and the selling is halting. 2 days for the markets to revive, for the discussions and the kind of nitty-gritties which we've gone through in the last couple of days. That would probably now start to ripple effect. But I think the last 2 days the markets have given a zone that the markets are very, very quick towards changing the nature and the mood if the news flow is not favorable. And that's the best way to try and put this market in a scenario, because just about start of this week, we were at a point where we were cruising almost at those life highs of 26,200 to 300 mark, and the markets were stable and everything. But then in the last 2 days, there has been a knee-jerk impact to the market trend. We've not just broken the back of the market in terms of the market breadth, but the way the large cap stocks have behaved in the last couple of days, and the selling which has happened for many of these large cap stocks, that I think has dented. Because we were discussing this almost for the last 1.5 odd month that the large caps are the ones where the markets are more dependent on, and they were doing a fair share of moving up higher. But that with this initial, with this knee-jerk impact or a mean revision for the large caps, that dents the hope for the index and the market participants.
Kunal, I'll bring to you a fun stat. 283 negative points is what RIL and HDFC Bank have posted for this week, which has gone by. Today, of course, RIL closed in the green, but that's the quantum of pressure from the largest of the large caps, just 2 stocks. Then there are 3 other stocks. Bharti, negative 50 points. L&T, negative 35 after what happened yesterday. And ITC, negative 25 points. And then there are a bunch of 40 stocks which would have maybe contributed 275 negative points all through the week. Now, just to fathom that RIL and HDFC Bank have carried markets lower by that quantum, and the pressure that brings to the Nifty is the perspective that we're trying to bring out there. But Kunal, one stock that stood out is ICICI Bank. 50 points positive this week, even though today it showed plenty of weakness. Now, you've been positive this counter, given the kind of moves, 2% lower today. Any changes to the thesis that you have?
Not really. I'll add to that fun fact also, Harsh, which you said.
Yes.
Just 2 days back, there was 20%, 18% stocks to be precise on the Nifty 50, which were trading below the 200-day moving averages. Guess the number today, today I think by close, the number would have gone up to almost 64% of the number of stocks in the Nifty 50, which are falling below their 200-day moving averages. And remember, 200 DMA is not a short-term moving average. It's an average of the entire calendar year, 200 days, to put it simply. So that's what I was trying to indicate, that why 200 DMA is very, very important and critical. Coming to your point on ICICI Bank, I think today's selling is more or less more like a mark-to-market or a margin-filling selling, because that generally happens. Stocks which have been holding up very well for themselves, they also, at the end of the corrective wave, come into selling pressure, because traders have to adjust profits from performing stocks and then balancing out into stocks where they're losing out. So I think in that sense, I would probably read this as maybe a one-off day for ICICI Bank, but the view and the trend still remains on the intact.
Okay, Kunal, we'll let you go on this slightly extended day of trade, if I can call it that, for you and me. But thank you so much for joining us as always and giving us that perspective. And viewers, thank you so much. That's a thank you and a goodbye from all of us here at ET Now.